Hello and welcome to another edition of B3 Talks. In the recent years, many multinational companies have been attracted by the economic growth in Asia, seeking for opportunities to expand their global presence. As the world's largest and most diverse continent, Asia is home to world-class tech and innovation hubs, advanced infrastructure, and emerging markets. All this, along with the GDP of many economies in the continent surpassing the growth of Western markets, meaning that expanding into Asia is strategic for many businesses. For capital markets and financial markets infrastructures, this could be the same. So in today's B3 Talks, a program which we invite special guests to debate about important topics in the capital market ecosystem, we'll talk about the Asian market. More specifically, about the opportunities for capital markets and how B3 has been working and positioning itself in the international markets. I'm Sérgio Gullo, Managing Director for Asia and Oceania at B3. And together with me, I have Nandini Sukumar, CEO of the World Federation of Exchanges, Elad Hertshten, Managing Director of Futures First, and Will Mitting, CEO of Acuiti. Thank you all for joining us today, and I'm looking forward to this debate, having emerging market stock exchanges in the center and the opportunity for proprietary trading firms from across the globe seeking for new markets to trade. I would like to leave our guests to introduce themselves first, and then we'll start with Nandini with the first question.
Thank you, Sergio. Let me go first. In that case, I'm Nandini Sukumar. I'm Chief Executive of the World Federation of Exchanges. B3 is one of our members. In fact, you're on the board. We represent market infrastructures, both exchanges and CCP, across the world. A third of our membership sits in Asia Pacific, a third in the Americas, and a third in EMEA, which is a broad region for us with continental Europe, UK, Middle East, and Africa.
Thanks, Sergio. Thanks, Nandini. So I'll introduce myself. My name is Elad Hertshten. I'm the Managing Director of Futures First. But today I'll speak on behalf of Mercury Derivatives, which is the trading entity that operates on B3. We have approximately 75 people participating on a daily basis in B3 Exchange. It's a great exchange for us, a great area for growth. And thanks for having me here, Sergio.
So my name is Will Mitting. I'm the founder of Acuiti. So Acuiti is a management intelligence research platform focused on the derivatives market. So we provide operational research into to create more transparency over technology, regulatory change, and operations. So we recently did a report with B3, which we'll speak to today, looking at proprietary trading interests and challenges in connecting and trading the market. And thanks for having me today, Sergio. Thank you.
You're most welcome. So let's go back to Nandini. Nandini, I have a good question for you. Please, could you shed some light on the Asian markets in general? How do you see financial market structures such as B3 establishing representative offices in these markets and working to attract Asian proprietary trading investors to Brazil?
First of all, Sergio, let me start by congratulating you and B3 for your new office. I think it's really a reflection, or it's a culmination of a lot of work that you have been doing in the region for many years. And indeed, when we talk about the region, that's one of the things I think that we should start with. It's not Asia, as everyone says, it's not a homogeneous place. It's full of diverse markets, diverse market infrastructures. They all have underlying common traits, but the scale and the diversity is quite staggering if you think about it. So let's look at Asia, for example. You have Southeast Asia, where you have very large markets and you have very small markets. In Asia, you have also Australia. You have China, which is really, as we know, it is an entire continent by itself, but there are 8 to 10 market infrastructures there. You have markets of all size, not just emerging markets. You have large developed markets. And then you have large emerging markets, such as B3 is a classic example of one in the Americas. And then you have your counterparts in Asia. And then you have small, mid-sized and small emerging and frontier markets. So really a very diverse region with market infrastructures and various stages of growth and evolution. So a lot of opportunity there for a market like B3, and certainly an interesting time to be in the region. The second point I wanted to make about Asia is that it has seen enormous growth over the last decade. So if you just look, at the statistics, let's just look at the last half, for example. If you look at domestic market capitalization, for example, it went up worldwide, let's say by 6.5%. But if you look at the geographical breakdown, in the Americas, it rose 32%, in Asia Pacific by 40%, and EMEA by 28%. And if you look through each of those markets, you will find in that overall mix, you will find markets like, Hong Kong Exchange and Clearing, you find Shanghai, you find SGX, you find the National Stock Exchange of India really driving that growth. You see similar trends, not identical, but if you look at volumes of exchange-traded derivatives, you look at IPOs, Asia continues to dominate the IPO stage, and if you look at trading volume in general, Asia has just had an unprecedented boom, the Asian miracle, if you like, for the last decade. So a lot of opportunity there, especially for an emerging market infrastructure that is non-Asian. Some points of similarity and some points of contrast. And finally, kind of looking at the way the region works. I think pretty much everyone realizes that it's very difficult to meet the needs of those diverse clients and those diverse markets from a different time zone. So establishing a representative office has absolutely been the way that most of the large global market infrastructures have gone over the last decade. And not just global non-Asian market infrastructures, you have a number of Asian market infrastructures that have opened representative offices across the region. So we look forward to your continued success as head of the Asian rep office of B3, Sergio.
Thank you very much, Nandini. Thank you for your comments. So now I'm going to Elad. Elad, when you talk about Brazilian and Asian capital markets, the first thing that comes to us is the time zone difference as potentially being a challenge for trading. Since you have a good view on the topic, having traders around the world, and as you trade on both markets, could you share some views with us on this topic?
Yeah, of course, Sergio. So I think time zone in our industry has become a very complicated concept. I think historically, when most exchanges were open for single-digit hours, then obviously time zone made a huge difference, and it really no one would want to start their day in the afternoon or early morning. Nowadays, most exchanges are open for long days, many of them for 23 hours, for example. So I'll take another Asian market, for example, Australian Exchange. Australian Exchange, in order to participate in it, we're also big clients of theirs. You have to be active in the Australian day hours, and you also have to be active in the US hours because the markets are open. And if you're not active, you're missing out. You're taking too much risk and you're not able to compete at a level playing field. So Brazil actually being a market, and I'm focused, I know there's multiple products, but specifically the fixed income derivatives, the market is open for 9 hours. So that actually is a huge benefit for us. And regardless to when the day actually starts, the time zone of Brazilian market is a fantastic one. And looking at the people we have, it's mostly discretionary traders. Now, discretionary traders want to be where there's the opportunity. They don't care if they start a bit earlier, a bit later. They just don't want to waste their day. They want to be there when there's opportunity. And opportunity for us is volatility and liquidity. And B3 provides both of those to an extreme extent, I would say. The volatility that we see in the short-term interest rates is unparalleled to any other market we access. And as I said before, and as you asked regarding the time zone, an exchange that is active for 9 hours only makes it very easy for humans to be able to compete in, because humans can work for 9 hours quite easily, whereas computers can work 24/7. It doesn't matter. So, and some of these exchanges, like I mentioned before, Australian exchanges, HFT, a high frequency trading algorithm, would have an advantage over humans. In B3, that's not necessarily the case.
Thank you very much, Elad. Thank you. Will, the topic that you like, regarding international proprietary trading firms operating in other markets. So in most of the emerging markets, Brazil included, there is a complex web of local regulations to navigate. However, there are other advantages that can be outweighed the hurdles and enhance the possibility to profit. Can you tell us about the advantages proprietary trading firms can find in emerging markets such as Brazil and others?
Sure. Yes, I think probably the top of the list is what was referring to with the volatility. If you look at, say, for example, the Brazilian interest rate base rate in Brazil has gone from 14.25 in Q3 2016 down to 2% in October 2020, and now it's back up above 6%. So in the past 12 months alone, the Brazilian rate has moved more points than the US, UK, and EU combined over the past decade. So I think the first point is the volatility, and you see that elsewhere. For example, the Turkish rate's gone from 25% down to 10, and then back up to 19. I guess that's at a time where there's been quantitative easing in the core established markets in the US, Europe, and UK, which has suppressed volatility and significantly reduced the potential for profit trading in a very narrow band of interest rates. I also think if you look at COVID, we saw a very different recovery profile that reflected itself in stock markets across emerging markets, with different parts of the world emerging from lockdowns and emerging from case spikes at different times. So those firms that had more access to global markets, I think, were able to trade volatility as and when it arose on an ongoing basis. I think volatility, without a doubt, is the top point. Second, I think, is the interaction with different market participants. In particular, the strong retail participation in many emerging markets. If you look at, say, the National Stock Exchange of India came out in May saying that in the last year, to the end of April, they'd added 9 million new investors to their market, and 33% of total trading on NSE in India last year was attributed to retail traders. A similar percentage you saw on B3, where it's gone from around 12% in 2016 to 33% in 2020. So there's a massive increase in retail participation that you don't see at all in Europe. Obviously, US is a different story in that respect in terms of what we've seen in the post-COVID trading environment. But certainly in Europe, I would say, I don't know the stats, but retail participation is a tiny percentage of overall market. So related to the retail participation, also you see the growth in participation. Another stat that NSE came out with, they've added 17 million new investors to its market in the year to the end of April 21. Just massive growth, and I think increased potential for that growth to continue. So you've got the volatility, you've got the ability to interact with different market participants. And then I'd just say the final point is the evolution of the exchanges in Asia and B3 as well as an emerging market exchange. So the evolution, I think, in that respect falls into two camps. On the one hand, you have initiatives to increase international participation, so such as Gift City in India. You've also seen, obviously, China opening up to more international investment in a staggered and deliberate way. But then many other regional initiatives, such as new product launches on Hong Kong Exchange and Singapore Exchange, to provide a kind of gateway to the region, offering more regional products so you can have a single point of access to trade across regional markets. And then also some unique opportunities. China, I think, is a great example of innovation in futures contracts. When I first started going to China in 2011, they talked about one contract launch per exchange most years. So often, some years an exchange wouldn't launch a new contract. And I think last year there was 12 commodity contracts launched by emerging market exchanges, which includes things like the peanut futures, just completely new concepts, completely new products to change. So again, that innovation by regional exchanges, I think, has supported institutional investors from across the world as they come into these markets to trade volatility against retail players.
Thank you. I'll continue a bit with you, Will, because recently Acuiti spoke with over 50 proprietary trading firms globally for a report on trading at B3. So can you tell us about some highlights and opportunities that you find out described in this report?
Sure. So yeah, as you say, so we spent a couple of months speaking to senior executives of proprietary trading firms across the globe about whether they traded on B3. Those that did, what they liked; those that didn't, why not, and what were the barriers to trade on the market. So I guess the as you alluded to at the beginning of when the initial question, when firms go into emerging markets, you almost always significantly increase bureaucracy just as a result of the relative immaturity of capital markets in those regions. There's then related to that, there's usually nuances in things like fee structure and how technology works, and simple things like bringing equipment in and out of the country you're looking to trade in can be much more onerous and have significantly higher requirements in emerging markets and other markets. So we spoke to firms about some of the challenges they faced when trading in Brazil. And one of the key points that came across there was how much the environment had improved as a result of recent initiatives by B3 to reduce friction when it comes to firms onboarding B3 as a market and trading into Brazil. There were some elements, I think, that there's ongoing changes being made, things like the fee structure, complexity of fee structures, which I know B3 is taking steps currently to address, really just to ease the burden of firms coming in. Because one thing we certainly saw is that the adoption rate amongst the top tier proprietary trading firms was nearly, or if not 100%. I mean, obviously, we can say 100% with absolute confidence, but certainly very nearly there, if not there. But as you go down to the smaller proprietary trading firms, tier 2, tier 3 firms, who don't necessarily have the big budgets to spend with exchange interaction, with onboarding processes, I think it's more important than ever that those barriers are being reduced. And certainly we saw that correlating with the initiatives at B3. But the main point that came across again and again was the fact that the burdens and the complexities are far outweighed by the opportunity to profit. A lot of the firms that came in first did so to trade the rates contract. Obviously, a unique contract structure takes some time to understand and bed into trading and risk systems. But firms that were trading it reported it to be significantly more profitable than on other markets, and not simply because of the rate volatility, but also because of the elegance of the contract structure. We also found strong demand for firms that were trading to increase what they were trading, to broaden out into more products and grow with B3 into areas like single stock options as B3 launches more in that sector. And then amongst firms that weren't currently trading the market, we found strong demand to revisit that and to onboard the exchange as they fully understand and appreciate the profits that their competitors and peers are earning on the market.
Thank you very much, Will. It was a really good report, and it is out. You can find this report at LinkedIn, Acuiti page, B3 page. It's available, the public report. So back to Nandini now. Nandini, in the beginning, in your first comments, you described beautifully the landscape of exchanges in Asia. Now, changing a bit for the landscape of Asian investors. How do you see the Asian investor accessing other emerging market stock exchanges like B3, for example? Is there anything that you could point out as a main hurdle or hurdles? And what market infrastructures can do to improve and make the life of Asian investors easier to access their markets?
So, Sergio, actually, it's a great question, and I was very struck by Will's comments, actually, because I thought he did a great job of laying out the landscape as well. When we look at emerging markets and emerging market infrastructure, and per se look at what triggers, inflow and outflow, we did some research on this a couple of years ago, and it's publicly available for those of you who are interested. It's on our website. But we found that the greatest predictor of foreign inflows into any emerging market is equity returns. So there's a positive relationship, obviously seen both at the level of individual market returns, as measured by changes in the broad market index for a specific market, as well as at the emerging market level overall. So for example, if you look at, expressed by returns of the MSCI Emerging Market Index, for example. So we actually quantified it and found that a 1 percentage point increase in domestic returns is associated with, I think, a $25 million increase in monthly inflows in the average market. So, all we can hope for is that well, not all we can hope for, but we all hope that the equity index goes up and you'll find the inflow. But more pragmatically, looking overall at some of the factors that international institutional investors look at when they want to come into emerging markets, or when they make their decisions. Obviously, the number one the number one factor that they all cited is corporate governance. So, it's very important from that perspective. Another such is the pool of investable securities or assets. So, at B3, for example, you have iconic companies, etc. So we find that in general, institutional investors, it's pretty obvious, they like to have something to trade. So the more attractive there is something to trade, the more likely you are to see these big institutional investors accessing the market. Slightly less significant, but still very important. Just from a statistical point of view, we found that the overall country inclusion into one of the benchmark indexes, whether it's MSCI or a FTSE index or an S&P, is important. Often, another factor that we found very much associated is the accounting standards, the international accounting standard that's used in the country. Pretty much institutional investors like to see widespread reporting against an international institutional accounting standard. We also find disclosure, for example, and this goes back to the corporate governance point. So if there is good disclosure, preferably in one of the main business languages of the world, that's mostly English, but French also, and increasingly Spanish and some of the others. So institutional investors like to be able to read easily disclosure or companies' reports. So kind of pretty straightforward things. From a market infrastructure point of view, it's fascinating. The most important factor that we have seen associated is, securities lending, borrowing. Institutional investors also like the ability to have to play in the market using tools such as short selling, for example, and that's really been a really important debate through the volatility of the last pandemic. Should short selling be banned? And at the WFE, our response is no, because it is a very legitimate, instrument to be used. So the other, on the other side, we found that companies or institutional investors as well liked to see a pipeline of products. So they look at the market in terms of potential. So their B3 again is very strong. So I'm sure, especially with you setting up a representative office in Asia, you will find increased interest in the Brazilian market. The pool of Asian investors who trade and invest internationally is growing and growing. There is enormous interest to look outside the region. And I think, that's a great opportunity for large sophisticated emerging markets that sit outside the immediate proximity of the region.
Thank you very much, Ali. Thank you very much, Nandini. Elad, let me ask you something. Currently, what do you think that are the main opportunities in emerging markets that you see around the market trading? And if you can contribute with your thoughts on the products trending mostly at the moment.
Okay, sure, Sergio. So first of all, the best opportunity we see in our emerging market, and even the best opportunity for growing further, we see more products and more things on B3. And I'm not just saying that because this is a B3 hosted talk. That's genuinely the case for a firm like us. And I'll just explain for a second why that's the case for us. There's plenty of very liquid and fantastic opportunities in most emerging markets. But the way we participate, we have more complex style of trading. So we trade mostly spreads and flies and additional complicated strategies. And for that, we need good liquidity throughout a curve. We need 6 or 8 very liquid contracts in the product that we trade. In most emerging markets, the main product is one or not one, sorry, but would be either FX or equity indices or bonds. Those 3 type of products usually have a very liquid front contract or maybe the very, very liquid 2 contracts, but it doesn't have a whole curve of 6, 8 contracts that are always liquid. So for us, there's a very niche set of products that work really well. Now, if I look at other emerging markets that could be suitable for us, similar to the DI1 on B3, which is our main product in Brazil, the Mex Exchange has also launched a similar product for the Mexican interest rates. But currently, that product is not liquid enough for us to really push and participate and add new analysts to focus on that market. But that's one that we're definitely keeping our eyes open on. Another one is the Korean exchange, which we think is a fantastic exchange. But the product, again, is not one that is fully suitable for us. It's the bonds. But we still participate there. We still think it's a great opportunity, but there's probably a limit to how much we can grow in that market. The next one, which probably everyone is looking at, is China, and we'll discuss it at length. Chinese markets are very interesting to any proprietary trading firm in the world. They have amazing liquidity, different kinds of contracts, some that would be extremely suitable for what we do, how we participate in the markets. The issue we currently have in China is accessing the markets and accessing those products. Now, they have opened some of the products internationally and they're adding more products with time. But the way they've done it to date is adding an additional firm to the domestic one. So basically, by you having access to Chinese markets doesn't mean that you have access to the liquid product and to the entire opportunity. You have to a lookalike product, which is available for the international players, and also the domestic ones can access it, but it doesn't mean that the liquidity would be there. So for us, China is a bit of a challenge because we're not at a level playing field with all the local participants. And we don't have presence in mainland China that will give us that accessibility. So as I was saying initially, B3 is the best exchange for us in terms of the emerging market, both currently and for future growth plans.
Thank you very much, Elad. Yeah, you touched Korea, South Korea. KRX is fantastic. Korean market is very dynamic, is very creative, very strong local investor base. And you mentioned China. So as you mentioned China, let's go back to Nandini because we think this topic could be very interesting to hear from WFE. Over the last 3 decades, China has been through a period of intense industrialization and trade opening. Today, it is the second largest economy on the planet, only behind the US. How how WFE see the Chinese market opening, Nandini?
So, Sergio, that's a great question. At the WFE, we have 8 members from the mainland in China. And the first thing to note about China is, again, as Elad said, it's a large market. It's now, I think, as you said, the second largest market in the world, and it's going to grow. I mean, it's very liquid. There's a strong pipeline on every product, right? We're talking about, IPOs where, when the rest of the world was trying to bring IPOs to market, our Chinese colleagues on our capital market call would tell us that, they couldn't process in time or quickly enough, all the demand. There was so much demand for IPOs, for companies to come to market. So in many ways, China, in every way, actually, China runs to its own rhythm. And the institutional investors and other infrastructure have always been interested in the opportunity of China. What has been the theme of the last decade is, of course, the desire for internationalization, and the Chinese market players have come out of China. They've, built partnerships. Look at Connect, for example, joint product, and multiple different ways, of doing business. Encouraging others to come in and do business in China, and I think that's a trend that will only grow. I think that you can't force it. You can't make it fast. It won't move. China won't move faster than it's ready to. So I think that's an important point to note. I think that they have a sophisticated regulator. The regulators, the CSRC, well, there's the People's Bank of China, but you have a securities regulator, the CSRC, that oversees security markets, that benchmarks against international best practice, etc. So you have that strong regulatory environment that is very much in touch with the international stage. You have sophisticated market infrastructures. You have huge markets. If you think about the China members, apart from Shanghai Stock Exchange and Shenzhen Stock Exchange, is a huge equity market. And then you have the distinct commodity markets, and you have the distinct futures markets. So there are a lot of markets there that are open for partnership and collaboration. There is a lot of product there that can be traded, and as Will and Elad mentioned, there's been an enormous amount of innovation. So I think that it's a well-trodden path. The market will continue to open because they've said this is their intention, this is their strategy. And for the rest now, I think there will be a lot of focus on partnership, because one of the things that all of you who do business in China knows is that it's important, to have a strong domestic and local presence, in addition to being that international market which offers an opportunity for the Chinese investor, market infrastructure, and anyone else to take advantage of.
Yeah, it is visible. Without any agreement, 3 of you, of course, have to mention China, because it's the most important economy in the region and globally. And we're very fortunate. We have our representative office in Shanghai, which gives us a clear understanding and vision of how China is important, how China is evolving. We have our colleague Francis Lee, based in Shanghai. So now I have one last question for all of you, and I'll start with Will. Please, how the exchanges and clearinghouse around the world are dealing with regulatory changes? Briefly, what is your opinion on this topic, please?
Well, I think Nandini is probably better placed for the for this question. But I think from our perspective, what we see the biggest challenge, I would say, for exchanges currently, apart from regional issues such as Brexit and the ongoing negotiations between the EU and the UK, which obviously has an impact on the regulatory approach for exchanges based in Europe. I think it's the crypto regulation around cryptocurrency. I think is the biggest challenge that exchanges face today from a regulatory perspective. Obviously, there's a two-system environment at the moment with vast amounts of trading in plethora of coins on unregulated markets or markets regulated in far and flung jurisdictions. So I think there's a very real danger that the traditional markets will become left behind if they don't quickly establish, alongside the domestic regulators, a framework for authorized trading of cryptocurrencies. I'm not a massive, I'm not a total bull when it comes to cryptos overall, but clearly it's the fastest growing market for trading. There's huge volatility, there's huge opportunity. The limited launches that we've seen so far in the US have done very well on the derivative side. So I think the big challenge from a regulatory perspective for exchanges over the next 18 months, 2 years, is to build authorized venues for crypto trading, both in spot and derivatives.
Thank you. Elad, do you have any comment?
Unfortunately not, Sergio. I wish I knew more, but I think it's for Nandini. So.
Okay, thank you. Nandini, back to
you. I will take that opportunity. I will respond to Will's comments because I think that's a great place to start. I mean, I think crypto is an exciting time. I think if you're an exchange, it's an opportunity. And I think WFE members certainly see it as an opportunity. It's a new asset class, and you don't see new asset classes that often. I mean, Will probably will be able to tell us, what is it? Well, every decade you see a new asset class. The other reason crypto has been good for the market overall is because it's brought a generation of investors who traditionally have shunned finance into markets. Now, the good thing that has happened in the last year is that people have realized the value of public markets, partly as a result of what we've seen in the unregulated crypto market. So people understand that you need to have, there's great benefit in having a public market where investor protection is enshrined, in its DNA. And regulators have also woken up to the fact that, there's money pouring into essentially unregulated markets. How do you ensure that investment keeps going? There's liquidity, but that it is, being fostered in a correct way, etc. So I think if you're an exchange at the moment, you're engaged in thinking about how you can design a market that allows investors to trade crypto in the way they want while remaining true to your principles. And that's not something they can do alone, so working hand in hand with the regulatory community, whose goals, exchanges and CCP shares, market infrastructures at the end of the day, in every waking, in every breath they take, they are thinking about, fair, orderly public markets. So how do you trade? How do you bring this new asset class onto those public markets? Stepping away from crypto at the moment, I think, and I would see it as an opportunity, not merely as a challenge. I think there's a tremendous opportunity there, and certainly very exciting to feel that there is that new generation of investors, young investors, retail investors, many of them who are thinking about markets-based financing for the first time. It's a great moment. We just need, as an industry, working in partnership to ensure we, take that opportunity correctly, and I'm confident that we will. But more broadly, we've had 18 months of the pandemic. The pandemic is still far from over, however much all of us, try to believe that it is. And what are the themes that have played out over the pandemic in terms of the industry and the regulators' focus? And, we've lived it at the WFE with you, Sergio, who we speak to so often. So at the WFE, we spent, in the early part of the pandemic, we spent a lot of time talking almost existentially about the need to keep public markets open when there's volatility, when there's time of chaos, when there's time of panic. That is when you want your public market to be open. It's the last time you want it to close. We also talked and have thought about, and will continue to think about, I think, as an industry, volatility and how you manage to tame that volatility. One of the most important learnings that we have tried to provide our stakeholders over the last 18 months is that volatility occurs. Volatility isn't, good or bad. What matters is the mechanisms you use to manage volatility. That's what's important, because markets wouldn't exist without volatility. So I think whether that's circuit breakers, which are or whether there are others like the debate around short selling, which I alluded to earlier. So those volatility related conversations are important and are ongoing from a regulatory perspective. Looking ahead also, I think that we have to think, we've all thought a lot about risk, enterprise risk holistically, in terms of, operational resilience. And the industry has been very solid. No one lives in this world in a zero failure regime. We've seen that, with other industries around the world. But as an industry, market infrastructure went remote at the start of the pandemic. And it's extraordinary, really, what markets, exchanges, and CCPs around the world have been doing. They have run the infrastructure of markets near seamlessly remotely, from people's living rooms, from people's bedrooms, all those things. That's an incredible achievement. I think that resilience is not, it's not a finite point. You have to be constantly working on resilience. And I know that as an industry, we take that responsibility very seriously. So as an industry, we're constantly thinking about how we can be, stronger and more resilient, etc. But that initial test, that we have had for the last 18 months, we have come out the other side, strong, we have come out capable, we have been robust, we have been there for our stakeholders. And that is not a coincidence either. The reason that we have been able to operate in a robust and resilient way is because, market infrastructures have spent the last decade investing, thinking, strategizing about resilience. And that will only continue. I cannot go without mentioning market data. I think that there is a debate that is being had. Market data is the exchanges that have created it. So I think there needs to be a greater acknowledgement of the fact that if data is the new oil, as we like to say, the oil is now rapidly going out of fashion. If data is essential, and the exchanges play a central role in creating that data, the data that people are squabbling about, it is the exchanges that have created it. It's an exchange product. And I think there needs to be, greater recognition of that. The conversations, the debates that are playing out now, these are bilateral commercial conversations in which market infrastructure's role as, guardians of public markets are being invoked for commercial interest. So I think that from market data side, I think as an industry, we have been clear about what we think, and we will continue to be. And finally, no conversation of this kind, can go without technology in multiple forms. Will talked about that a little bit when we talked about crypto, but let's talk also about cyber, where it's an ongoing work at the industry to ensure that we remain as resilient as possible. And then, of course, from the risk side, on the CCP side, a large work plan of multiple different topics that are coming both before the pandemic and now in the wake of the pandemic, as regulators look back and reflect on the lessons learned, what worked, what can work better, etc. So a pretty full regulatory agenda coming out of the pandemic, but I think it's been a good track record. It's been a strong 18 months for us as an industry. And Sergio, I know that you've played your part in it. B3 has been, has been there for its stakeholders. It's been there, for its customers, and certainly, has led the industry at the WFE board on a number of important topics with this one.
Thank you very much, Nandini. And Nandini, we have to incentivize our audience to look at the white papers, the reports, the surveys that WFE has been producing. I congratulate you and your team for the great content, the professionalism, and all the good information you are sharing with them. Thank you very much, and congratulations to you and your team. And
I will pass on the message to my team who do the hard work. Thank you, Sergio. And for the rest of you to decide, please, don't hesitate.
Yes, thank you very much. So as we are reaching the end of this edition of B3 Talks, I'd like to speak about how B3 is furthering its presence in the international markets. So we have representative offices in London, Shanghai, Chicago, and now opening our representative office in Singapore to support local institutional investors actively trading at B3 and to promote products and services to potential new investors. We are also shareholders at the Chilean, Colombian, and Peruvian stock exchanges. We've been engaging with the international proprietary trading community and developed new products, incentive programs, and invested in technology to meet their needs to better access B3 markets. B3 has also invested significant time in resources over the past decade into understanding the demands of international proprietary trading firms and developing the market to accommodate these requirements and increase their participation. Moreover, B3 throughout the past 10 years has deepened itself into the creation and development of market maker programs aiming to foster liquidity to its products and ease up the access to our markets by different types of investors. In addition to the large technology investments, B3 has expanded its products range with the launch of several new derivatives contracts, including the DAP, an interest rate contract, which is designed to offer exposure to real interest rates. Over the past 5 years, Brazil has been among the fastest growing derivatives markets in the world. Last year, B3 recorded the second highest derivatives trading volume in the world with 63% volume increase when compared to 2019. This is a proof that B3 and the Brazilian market can be very attractive and competitive. In all, I'm more than happy to share that we do have the infrastructure, expertise, competitiveness, and we are prepared to further venture into international markets and to host in our local market international proprietary trading houses seeking for new business opportunities. I want to thank our guests for joining me today and for their meaningful contribution for the important points on this subject. Thank you very much.
Thank you.
Thank you, Sergio. Thanks, everyone.